Bloomberg Audio Studios. Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Jess Menton sitting in for Alex Steele here today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. Earnings day, big earnings day. It's a big earnings week, actually, coming up. A lot of tech names. We'll keep an eye on that. The story of the morning is, I think, kind of just from an earnings perspective, is been McDonald's. It's been in the news a lot recently with the E. coli breakout. E. coli? Yeah. E. coli breakout. Anyway, stock put out some numbers today. I thought they were okay, but some international weakness. Same-store sales still negative. That's a challenge for them as they try to build traffic there again. This quarter does not include some of the concerns that they've seen over recent weeks. Michael Halen joins us, senior restaurant and food service analyst for Bloomberg Intelligence. Hey, Mike, what did you make from McDonald's in the latest quarter? And then maybe more importantly, what is management saying about kind of what they expect their fourth quarter traffic to look like?
Yeah, unfortunately, they didn't give us too much information about the fourth quarter. I'd say the biggest takeaway from this call, and the reason why the stock is up right now, although it's not knocking the cover off the ball, is the fact that their initiatives, including the $5 value meal bundle, the $5 meal deal, I should say, the chicken Big Mac, and some of the other initiatives, better operations, had actually led to a mid-single-digit same-store sales increase and positive traffic for the first 3 weeks of October. And so the street's kind of taking that as a positive right now. In terms of the fourth quarter, it was, they didn't give us much information. We did get a nice report from Bloomberg second measure data yesterday that showed same-store sales were down 9% last week. So that basically wiped out the mid-single digit gain, and they're probably a little bit from like flat to up modestly here in October, right? And so, it was kind of a good news, bad news last couple days for McDonald's.
Well, John, you were asking what does a $5 meal deal include? It includes a McDouble or a McChicken sandwich, small fries, 4-piece chicken McNuggets, and a small soft drink. That's solid for $5. So that would drive traffic.
I miss the proper dollar menu.
Yes, exactly.
I was always a big fan of that in college. But I would point out, like in 2015, you saw other companies like Chipotle that were hit by E. coli outbreaks. And unfortunately, at that time, Chipotle had to temporarily close a number of restaurants on the West Coast. What do you think we can glean from other instances when this has happened in the restaurant industry and how quickly this could be cleared up?
Yeah, well, we think this is very different than Chipotle. So a big part of it is just the operational differences. McDonald's is a closed kitchen. It turned out to be the slivered onions. And so it was one item. It wasn't, beef patties spread across many different products, right? It was just the onions served in the quarter pounders with cheese. So we think this outbreak will be smaller than we saw with a lot of other chains. Chipotle was also unique. Chipotle same-store sales dropped for 5 straight quarters. They were down 20%. That first year. But, their food is out in the open, right? It's behind a sneeze guard, but, it can get, contaminated by multiple different employees, even some of the customers potentially, right? So it's a much harder operation to get right at Chipotle. And for some of those reasons, we think it's going to be a lot shorter and it's going to be a lot shallower. That being said, I think fourth quarter same-store sales are definitely going to take a hit. I think people are going to be turned off from McDonald's. I think it'll probably spread a little bit into the first quarter next year. But McDonald's is working hard to get those U.S. same-store sales kind of back on the right track. It's going to be about value. There's going to be, the $5 meal deal is going to go through year end, and expect to see more of those type promotions next year. They're going to roll out an everyday value menu in the first quarter. That's should help boost results next year. Better operations, more chicken sales like the chicken Big Mac, more digital sales, and they even hinted at some fourth quarter food innovation coming out. So they're working hard to try to course correct here.
Something with McDonald's I always like to keep an eye on for a telltale sign of consumer confidence is the French fry indicator, because you can tell if how French fries are done and how the number of people ordering fries can indicate sort of sentiment. What do you think with sort of the latest earnings and what you can glean from that, and what that really means when it comes to what consumer confidence can tell us with the French fry indicator?
Well, listen, I'm not looking at the French fry indicator, to be honest, but what we're seeing and what we think we'll continue to see is low income consumers struggling. And so McDonald's, their strong result in the first 3 weeks of October, a lot of that was driven by being able to attract low income consumers in with a very strong price point. And but inflation continues to hurt the low income consumers, right? We see this K-shaped economy where low-income consumers are really pulling back on their restaurant spending, but right now asset prices are near, a lot of them are near all-time highs. The U.S. stock market's near an all-time high. Gold and silver have been ripping higher. Bitcoin's approaching another all-time high. Home prices have held in throughout the higher rates and everything else and are near all-time highs. And so we think, upper middle income, higher income consumers are all doing well and spending, and our chains are trying to attract those customers.
So, Mike, in your research coverage universe, what's kind of the best name or two or three that kind of stand out? Is there a sector in the restaurant business that you like better than others?
Yeah. Well, I think fast casual has kind of outperformed a bit to some of the names we cover anyway. Not the entire industry, but Wingstop has done a great job attracting both younger and higher income consumers into their brand, and they're absolutely knocking the cover off the ball. Chipotle's done a great job with their digital sales and strategic pricing, and they're continuing to draw consumers that see value on the plate there. And then Texas Roadhouse is another one that's absolutely crushed it. We're not super high on casual dining, but they've been a machine, man. They're driving people into the restaurant with a lot of value on that plate. Right. And a very good experience. And that's another one that's killing it. I think their same store sales are actually even better than Chipotle's over the last 5 years trailing. So,
okay.
Yeah.
All right, Mike, always good to catch up with you and get the latest on the restaurant biz. And McDonald's here today with their earnings. Stock trading a little bit higher here. Michael Halen, he's a senior restaurant and food service analyst for Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So go check us out there. Big tech earnings. It starts today after the close with
That's
our good friends at Google. And then we're going to hear from Meta and everybody else along the line, Apple and Amazon and all that kind of good stuff. So when you want to talk tech companies, you want to talk tech earnings, you need to talk to Gene Munster, managing partner and co-founder at Loop Ventures. I think one of the more tenured, reasonable voices on all things technology. Gene, thanks so much for joining us here. Let's start with Google. We're going to hear from them after the close here. The stock's up a little over 20%, but it just feels like there's some concerns around Google and their core search business, perhaps under some type of threat from AI. How do you position the Google story here, and what will you be looking for?
Paul, you nailed it. I mean, that is what I would identify as the pressure point, the single piece that matters the most. This is more important than the Google Cloud number. A lot of investors are going to be focusing on the Google Cloud, but keep in mind, clouds call it 12% of revenue, search is just over 50%, and cloud is not in front of some existential threat related to AI. And so the quick backstory is that Google search in the March quarter was up 14% year over year. It was up 14% in the June quarter, so showed some surprising strength quarter to quarter there. The street's looking for plus 12, but this is where the plot thickens, is that in the September quarter, this will be the first full quarter where AI overviews powered Google search in the US. They launched in May, so it got a partial quarter in the June quarter, but we're going to see the first full quarter. And then they launched another 100 countries in the month of October. So that's going to impact the December results. But the reason why this search number is so important is that if, in fact, the U.S. search business holds together for the first full quarter, that would be the most, I think, substantial data point that Google investors can have to feel comfortable about how this transition over the next 1, 2, 5 years is going to go for Google, that they're not going to lose share to the likes of OpenAI. And so I'm really focused on that number. Just one other kind of the inside baseball here. Google doesn't break out U.S. search revenue, so we're not going to get really a clean look at that number. It's just a global number. They do break out Google revenue in the U.S. It was up 18% in the just reported quarter. It's expected to be up 12% in the September quarter. So if they do better than that 12, I think it's going to be a good view of AI overviews and keep Google investors confident that this company can navigate this seismic change.
Of course, as you know, Gene, we're going to have Meta Platforms after the bell on Wednesday. And when you look year to date for Meta, up about 66% compared to about 20% roughly for Google. What are you watching when it comes to Meta and the AI story?
I mean, the bar is much higher. The plus 24, the street's looking for, I think, 18% growth for this quarter, or 22, I should say. It peaked at 24% growth and is at 22%. I mean, it really comes down to their advertising growth. And ultimately, if they can continue to keep that going, AI is impacting all their business. Another important factor is their daily active users, 3.3 billion. I mean, this is a remarkable number. Up 6% year over year. It was up 7% in the previous quarter. They just keep cranking, and I think it's testimony to how addictive Meta's products are. Just really incredible.
And the stock market agrees with you, Gene. The stock's up. It's been one of the best performers of kind of the big tech names, particularly
up 24%.
Yep.
Over the past 3 months, Nasdaq's up 7%, Paul.
Yeah.
I mean, it's just continued to power forward, and I would stress that point that the bar is high for Meta going into this earnings. Trades at 24 times, but this is just an overall revenue growth story. And Zuckerberg has kind of made the case to investors more recently at their Dev Day that they're just going to be AI across all of their products.
And Gene, there was a time not too far ago, long ago, when people were concerned about the spending at Meta, particularly on the metaverse. What's the thinking now about how management's thinking about that?
Well, they've gotten a pass because the growth has accelerated essentially to it kind of had bottomed at right around 12% and then accelerated up to 24% over the past year and a half. And so that kind of has, I think, kept investors in a comfortable place. But the spending on Reality Labs, this is the group that's predominantly working on some form of AI glasses, something that's more like the Ray-Bans that they have. They're very different than Apple's Vision Pro. But the spending on that group continues to be aggressive. And specifically is that they're expected to lose about $20 billion this year. I mean, to put that into perspective is that on a similar type of initiative for Vision Pro, Apple will spend about $2 billion in development a year. And so we're talking about kind of a 10x magnitude of investment that they're making. And to answer your question, Paul, is that investors are giving Meta a pass right now. I see their aggressive spending in Reality Labs as a win-win for Meta long term. If, in fact, these wearables do take off with their Orion project in the next few years, then you're going to see some revenue growth, and that would be viewed as a positive. And if this doesn't take off, they're going to cut spending, and that should be good for earnings. And so in kind of a strange twist of events, this Reality Labs is actually setting up to be a positive for the stock in the next couple of years.
When it comes to people talking about the AI potential slowdown in growth, but of course there are those base effects, right, when it comes to big tech, because in 2022, obviously there was such a low bar. We were in a bear market. Earnings projections were a lot lower than obviously last year once NVIDIA had that gangbuster revenue forecast last May. In 2023, obviously the base effects were a lot more dramatic. So when you're looking at the kind of year-over-year growth, numbers around 20% for the Mag 7, obviously not quite as high as the average, more than 30% growth in 2023. But kind of what do you make of that when you see more of the growth stocks and in the projections for their profit growth coming more in line with the rest of the S&P 500 next year?
I think investors are missing this. I think that this may be kind of an uncomfortable. I believe this is going to be an uncomfortable truth around AI and what it means for big tech. Is that this is going to be more significant than what I think investors believe. It's going to grow faster for longer. And I think what you just described, agree with all those facts. And ultimately, there's this sense for investors that we're just one quarter away from some sort of data point that's going to show that the substance is not going to reach the hype. And I suspect that, we may get occasional data points that are to kind of the bearish case of AI. The overwhelming body of evidence we're going to see in the quarters ahead are going to suggest that this trend is unstoppable. And that's some pretty high bars. I like to be measured in my expectations, but I do believe that these companies, most of them are going to see growth higher than what investors think. I'm already tuned into the 2026 growth numbers. Most of them for these big companies are kind of in the low teens range. And I suspect that the growth will be mid to high teens.
Gene, thanks so much for joining us. Really appreciate getting a few minutes of your time. As always, Gene Munster, he's a managing partner. He's a co-founder at Loop Ventures based in Minneapolis.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Consumer confidence data came out. 108.7, the consensus was 99.5. Prior period was revised up to 99.2, so a big jump here relative to expectations in the last period. Let's break it down. Jess, we check in with Dana Peterson, chief economist at the Conference Board. Dana, put this number into context for us. It seems certainly really good relative to what the market was expecting.
Yes, definitely. Consumers were on the whole pretty happy in October. Certainly they think the present situation is better, and also expectations, and notably expectations for jobs were positive for the first time in almost a year and a half. So there's really good news out there.
So what do you think this means as far as the direction of the economy here?
Well, the U.S. economy has been doing quite well, and indeed, consumers have been driving it. We saw in the tracking data from retail sales and also from the BEA that consumers are buying goods, they're buying services, and that's certainly supporting growth. And we're seeing that finally show up in confidence. Indeed, consumers were getting a little bit worried about the labor market over the summer, but then we had those blockbuster payrolls numbers. Most consumers are seeing their incomes rise because wages are elevated. Most consumers are working. We are seeing a little bit of layoffs here and there, but again, the predominant sense among consumers, at least for this month, is that they're okay.
How much, Dana, do you think is impacted at all by the Fed cutting rates? Does that come into your calculation here?
Absolutely. We have one question where we ask about interest rate expectations, and that measure actually ticked up. And we do have write-ins where consumers said that they're not as convinced that rates are going to come off. But then we did see some who were saying, look, the Fed has cut interest rates. We're seeing a little bit of improvement in that. So certainly we're going to need more interest rate cuts before consumers probably come out strongly and say, yes, we're confident in this rate cutting cycle. But consumers are starting to get out there and buy big ticket items because they're cheaper, not so much because interest rates are lower, but as interest rates fall, we think they'll buy more cars and furniture, things that they need to finance.
All right, some pretty solid numbers. I also know the Conference Board expectations data point came in at 89.1. That's versus a revised 82.8 from last month. So also in terms of expectations, better than expected. Dana Peterson, thanks so much for joining us. Dana Peterson, chief economist at the Conference Board.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jess Menton sitting in for Alex Steele today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well, youtube.com. Head there, search Bloomberg Podcast or Bloomberg Live Radio. That's where you'll find us. Speaking of YouTube, what would you like to hear on Bloomberg Radio? Help make shows like ours even better by taking our Bloomberg Audience Survey. Visit youtube.com/Bloomberg Podcasts and click the link in our profile or community section to take the survey, which is hosted by our partners over at Material. Fill it out now at youtube.com/Bloomberg Podcast. Our next guest, this is how it's going to work, folks. I'm going to ask a question, and I'm going to turn off my mic, and John and I are going to sit here and listen and try to get a little bit smarter.
And take notes.
Neil Grossman, he's a co-founder and former CIO of KNG Capital, joins us here in our Bloomberg Interactive Broker studio. We're in a suit today. I can't remember the last time I saw you in a suit. Neil, we got a lot of economic data. We got right smack in the middle of earnings. All that's important. But I think since we have you here, I would just love to get your opinions about how you think the markets are digesting a pretty big election next Tuesday. When you talk to clients, are you saying, hey, if Trump wins, think this, if Harris wins, think that? How are you kind of positioning all that?
Well, I think there's two levels to this. Oh, by the way, thank you very much for having me. It's a pleasure as always. At least as a start, both of the platforms seem to be talking about spending a lot of money. So the first question is, what's the impact of that on the economy, on the Fed, and then you can try and maybe zero in on what the theoretical differences are between the two. Look, if you look at the economy and where we are and where we've been, I would look at the July and September Fed meetings and just scratch my head. We had functionally two fairly weak, or one fairly weak and one moderate job numbers that propelled the Fed to what looked to me like they were panicking. And it turned out, of course, with the revision that really wasn't the case. So I think where we find ourselves right now is a couple of things. One, the labor market is fine. There are going to be some real unusual impacts over the next number or two because of the Boeing strike and the hurricanes, which really affected a pretty significant part of the population. And I don't know how to read the employment numbers now, but I will tell you this. I think my daughter lives in St. Pete. If you go down to St. Petersburg and you drive, and the miles and the miles and the miles of people's lives have been destroyed that have to be rebuilt, there is an enormous amount of money that is going to be put to work in this economy. Forget the fact that we're running 8 or 9%, deficits, which is historically staggering. The biggest question you might ask yourself is, can they actually address the deficits without having a significant economic impact? Because to go from a deficit growth rate of 8 or 9 to back to traditional 3% probably will be a very difficult task.
I've heard candidates promising the world, and I don't know how they're going to fund it. Liz Truss kind of ran into the same problem. Where are the bond vigilantes in all this?
You're starting to see it a bit. Look, the yield curve, I think the last time we were on, we were talking about yield curve structure, and it's steepened a lot.
Yeah.
And I suspect that this is one of the problems what the Fed did. There was absolute panic in the way they did things. And this concept of recalibration, to me, it's an awful laughable word. It's going to be, recalibration is going to become the new transitory. The bottom line is they don't really know what a neutral rate is, and they certainly don't know what a neutral rate is when we're spending money fiscally like it's rain. So if they really wanted to try and ease in and understand the impact, this would have been a very slow, elongated process watching. In the meantime, what happened? They not only cut 50, but they've sort of promised that they think you're going to be another 200 basis points in short order. And the first thing that happened, of course, is the yield curve has started to steepen like there's no tomorrow. If you really want to look at things, to me, the Fed focuses on short rates, but at the end of the day, long-term interest rates are an indicator and a measure of what you should be expecting for long-term growth and how you manage the investment and capital allocation decisions. And I don't see any reason to think that if they keep cutting with liquidity already just beyond imagination, stocks at all-time highs, very high deficits, we're still at relatively low rates of unemployment. A lot of the wage settlements have been very large, by the way. The last one and we have not seen most of the government workers, union workers, ask. Can you imagine? I think there are 25 million people employed by governments in this country, which is about 1 in 6. Can you imagine if those union workers are going to insist on the same nature of wage agreements going forward? This can't be handled.
So, but I mean, in terms of the deficits and the national debt, I started working on Wall Street in June of 1986. It was an issue then. It's still an issue.
Remember the national debt clock in Times
the
Square?
national debt
Yes,
clock.
it is. And do you know what the unfunded liabilities are? 2 to 300 trillion, which is, I mean, that dwarfs all the problems. Yes, and part of that is, look, Social Security is going to run out of money, trust fund, and then that will go on to the budget as well. So look, I don't know if there's time left to solve the problems or not. I don't think history teaches you that you can avoid reality, and our deficits relative to the nation's capacity are certainly causing the seams, or may cause the seams to burst. And the sooner you deal with a problem, the less you usually have to do to solve it, and the easier the transition.
But there's just no political. There's never, ever been any political will to deal with this.
Well, how do you look? I think something on the order of 65% of the working population pays no net taxes. And
they pay no net taxes?
Yes, when you look at all the benefits and add it all together, how do you tell people, and I have this discussion with a lot of people, I mean, how do you tell them that they're going to lose something? That's a very difficult thing to start with. And then you end up with these discussions about, well, your Social Security and Medicare, Medicaid need to be cut. And they say, well, I paid for this. I said, well, you really didn't pay for it when you look at the projections. The problem is you're relying on the future to continue to pay for your problem. And I don't know the answer to this. I think we've missed opportunity after opportunity to address it. And
again, as John said, I don't hear either candidate talking about that.
Nobody
constructively.
Look, even the Republican, what's his name, McCarthy and Mike Johnson, both of them, when asked, every time they sit down to negotiate, the first thing they say are entitlements are sacrosanct; they won't be touched. That's functionally. I think the actual number is we historically take in 18% of GDP and traditionally spend 21%. And by the way, that 18% is consistent across almost every tax regimen we've ever seen. But if you went back 20 years ago, 1/3 of government spending of that 18% was entitlements. We're beginning to push. I think we're very close to where almost every dollar coming into the government is going out in the form of entitlements, and we're not. So the extra 8 or 9%. Or above that, or actually, I guess it's about 9% of incremental spending is all deficit funded, and it's going to be a very painful.
There was a time where you had bipartisan kind of consensus, like a committee, Simpson-Bowles. But right. I suspect that environment is long gone, though.
What was Phil Graham's partner's name in the same thing? Graham
Dodd?
Graham Dodd.
Yeah,
Dodd.
Graham Dodd,
Same thing. That's the way. I mean, it's sort of kick it down and put it to some sort of under the counter committee, and hopefully you listen. But it doesn't.
All right.
Remain.
So given that dire backdrop, what do you do in the financing world? What do you do in the investing world? How do you think about it?
Yield curve, number one, I believe. If the Fed is going to continue easing, the long end of the yield curve is going to be under pressure.
Okay.
How high it goes, that will be a function of inflation. I do think you're going to start to see inflation in ways you don't want to. For example, again, the southeastern issue, used car prices are already being pushed very high down there. Cost of construction materials going high. Probably labor costs are going up in those ways. So some of the broader pictures, that's not the whole United States, obviously, but there is likely to be cost of housing, by the way. So I think that there is a lot of risk that you are going to see higher inflation numbers over the next 6 to 18 months just from that. Now, was that going to be from a 2.25 and 2.5, or is it going to be from a 3, or is it 2? I don't know, but I suspect that the progress towards lower inflation is going to find itself struggling for the moment.
So what does the Fed do November 7th here, 2 days after the election? We probably won't know, who's the winner.
I suspect they have more room to say, look, the data since we talked about this has been well above expectations. We'll see what the employment. The problem is the employment data could be really weak.
Yep.
And so they could say, look, that number is really bad, or they could say that number is sort of distorted by factors beyond our control. My suspicion is they're supposed to say that unless you see an inflation rate drop to 2% or below, and that includes a core rate which is still above 3 that say drops to 2.6 all of a sudden, I think they're supposed to say we need to, we've already had a significant impact, and other things being equal, we have time to take our time. I don't know if they feel that they can do that, because I think there are things like stock markets that they worry about more than other things.
And they it's almost like they did set the expectations for
But that's the problem. They shouldn't be setting when they tell you they're data dependent. I guess you can laugh about it, but
right.
When they tell you they're data dependent and the data is up in opposition to what they thought it was going to be, that they're supposed to, take a step back and try and understand what they were doing. So I don't know what they do, but I suspect, given all the current data, that 9 months from now, whatever you thought the rates were going to be in the absence of a significant change, they're going to be higher than what you thought at the front end, and they're going to be higher than what you thought at the back end.
All right, Neil, great stuff as always. Neil Grossman, he's the co-founder, and he's a former CIO of KNG Capital, coming into our Bloomberg Interactive Broker Studio. Just give us some thoughts here as we parse out this market.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's look at crude oil here. We've had a kind of a de-risking of crude oil in the last week or so. I guess on the backs of Israel's retaliation against Iran was a little bit less than expected, maybe dialing down the tensions a little bit there. But whenever we talk about global oil, we want to talk to Ellen Wald. She's a president of Transversal Consulting. Ellen, what do you make of kind of what's happening to global crude oil prices here? Is it simply kind of taking maybe a little bit of that geopolitical risk out of the price of oil?
Yeah, that's what I think we're seeing. At least yesterday was quite the day for de-risking. I think Israel really made a very concerted effort to let people believe that they were about to attack Iran's oil production and export infrastructure, and it seemed that the market was really taken with this, and there was definitely a lot of talk about, Israel potentially doing this and the effect it might have on the market. And so I think that now that risk seems to have passed, or at least been postponed for a while, we're seeing oil prices really come down as a result. I do think that fear was totally misplaced. I think Israel cultivated an image that it was going to do this, even though the likelihood that they would do that was actually quite small. So for people who didn't actually think that this was going to happen, there was definitely the possibility to kind of ride this in an interesting way. But now that we're past this, kind of hump, at least right now, there's more of an opportunity for the supply and demand issues to come to the forefront. And I think that's what we're seeing in oil prices now.
I'm glad you brought up supply, because walk us through how oil traders are really split right now and whether OPEC will hike supply in December.
Yeah, this is, I think, the really big issue that, oil traders are looking at now, because OPEC has already, pushed its plans off once. They made, they set up this whole plan for these very gradual increases. They set it up, they announced it, they've given the market ample time to get used to this, and yet we're still seeing it being pushed off and pushed off. Initially, OPEC's forecasters had a much more optimistic picture for what demand was going to look like this year, I think, than other people did, and they've really had to trim that forecast for demand growth back. And so as a result, the group has pushed off its plans to increase production and to implement this kind of gradual plan. They already pushed it off, but they're set to start doing this December, January. And so, the big question is, now that demand is looking pretty weak, we're still waiting to see what's going on with China. Is the group going to make another push it off again? And I think that's the really big question. There definitely seems to be a split. I think OPEC itself doesn't know. They did recently issue a downward revision in their forecast, which could be an indication that they're setting things up for another to push it off again when they meet in December. But no one really knows.
So, Ellen, you mentioned China. What is the feeling about demand coming out of China here? It's I guess on the margin, it's been weaker than expected. Is that something that the market thinks could could go into next year?
I think it is at this point. It's very interesting because there's definitely a lot of skepticism about demand in China, where it's going, what this stimulus plan that they've been talking about, is that really going to actually result in higher demand? Is it really going to provide the kind of economic stimulus that is needed to really, push oil demand higher? I think that there's a lot of skepticism about that. What's interesting, though, is that the CEO of Aramco recently spoke, and he's much more optimistic about demand from China. I think that may in part come from the fact that he's very much focused on crude oil products and petrochemicals, as opposed to just straight crude oil demand. The market has been very focused on the diesel, the distillate demand in China, which has been rather disappointing. Whereas I think he's much more focused on the petrochemical demand, which he sees as growing, as opposed to just straight crude oil, which is why there's kind of a disconnect between what Aramco sees for China and maybe what other forecasters are looking at for China.
As you know, especially when it comes to looking what oil could mean for the trajectory of the global economy. I mean, just looking right now, the Atlanta Fed GDP model just got updated. It's actually for the third quarter, it's 2.8%, revised slightly lower from 3.3% recently as well. But still, nonetheless, it's been trending higher over the past month as we get more of the third quarter data coming in here. But when it comes to OPEC and if whether or not they push again off those planned increases, what do you think that could translate when we're looking kind of more globally and especially U.S. economic growth?
Yeah, I think it's really a big question right now. I don't think that you can't say, it's not bad economic growth. We're not, we're not in a depression. We're not seeing things go backwards, but it's just not the kind of growth numbers that we were expecting, or that a lot of people were expecting to happen. I do think, growth is cyclical. There are these cycles, and it's not like this is, kind of the end or anything like that. There's still a lot of opportunity for growth out there. I do think it, depends on where you're looking, what indicators you're looking at. Different sectors, are experiencing different issues right now when it comes to crude oil. I do think that we are seeing a big shift to increased petrochemical production, and so there's a lot more crude that's going to that, and also a lot more natural gas feedstock that's going to that, as opposed to just straight crude for transportation fuels. And so I do think that we're seeing this as a shift and a change in the market. And so we need to maybe look at the numbers a little bit differently than how we were looking at them previously.
Ellen, how's the U.S. or the North American oil producer behaving these days? I'm wondering, are they supportive of the market, or are they, drill baby drill? What's going on with the North American supply source?
That's a really good question, especially because there's a lot of speculation about kind of the fracking industry starting to fall off. The production is going to, start to decline, or at least it's not going to grow. We're really at a high point right now. I mean, we're having massive amounts of production. The U.S. is the largest producer in the world. The question is, can it go higher, or should it go higher? And I think that U.S. crude oil producers are in a very different position now than they were 2 years ago, 3 years ago, 5 years ago, certainly. And so there's a lot less emphasis on, we need to drill, baby, drill. We don't need to drill, baby, drill. We've got much more complicated production techniques that can get a lot more out of every well. So there isn't a need to necessarily drill new wells all the time in order to produce those barrels. And I think that because of the massive amount of consolidation that we've seen, they can be a lot more strategic about it. And so no, that doesn't mean the U.S. oil industry is about to fall off a cliff, but it does mean that they are making more strategic decisions about production and how production is going to come online, when it's going to come online, whether it's worthwhile. And that can maybe look like fewer wells being drilled, but it doesn't necessarily mean that, we're about to hit a cliff and production is going to necessarily decline.
Hey, Ellen, whenever you're talking with oil traders, what are some of the key sort of technical levels they're looking at, whether it's WTI or Brent?
Well, I think that there's a lot of discussion about, okay, what's the point that WTI has to hit when it's going down in order for the U.S. to start buying barrels to refill the SPR, because that has definitely resulted in some, increasing in the price today. Just today, the U.S. said, oh, we'd like to, we're thinking about buying some more oil for the SPR, and the prices go up. So there's certain limits there. I do think also that there's this indicator for OPEC. OPEC wants, X price per barrel, and they're going to do whatever they have to do to get it. I think that that's not necessarily the case. I do think that OPEC and certainly Saudi Arabia would love to keep Brent around $80 a barrel, but I do think they realize that they may not get that, and they're willing to work with, within the confines of what they can. But there's certainly this idea that they'd like it to be a bit higher. They'd like it to be more closer to 80 than 70.
Ellen, thank you so much for joining us. Really appreciate it. Ellen Wald, she is the president of Transversal Consulting and a senior fellow at the Atlantic Council, joining us via Zoom, talking about global oil.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is the story I've been wanting to read for the longest time. And Jess Menton's here, sitting in for Alex Steele. I'm Paul Sweeney. AAA bonds go bust and reveal depths of U.S. office market crash. This is exactly what I've been waiting for.
You are all about the in-office.
Yeah,
Yes.
and I just look down 3rd Avenue and I say, empty,
Right.
half empty. Somebody owns the mortgages on those things.
Yeah.
It's going to have to come home to roost at some point. Carmen Arroyo and her team at Bloomberg News, she's a credit reporter for Bloomberg News. They have this story out here today. Carmen, what are you finding on some of these bonds that were AAA rated, which means I don't have any real risk here? What's happening to some of these real estate-backed bonds that were AAA rated?
Sure. So in May, we saw the first AAA bond, commercial mortgage AAA bond, being hit, backed by a single office property. And then we started digging into basically the data to see what other buildings could get hit. And the result is there's a few. A ton of the office properties across the U.S. have been distressed for years. It just takes a long time for that to reach bondholders, and now it's starting to get there. So we kind of analyzed the data. We saw at least 12 other buildings are said to have some type of loss. Some will be at the AAA level, some will be just the investment grade portion, but there's definitely a lot of more pain to come.
Which regions across the U.S. are most vulnerable?
It's all over the U.S. actually. We saw there's buildings in New York, of course, Chicago, LA, San Francisco, but there's also buildings in Kansas City. It's kind of everywhere.
But if I'm holding a AAA bond, I expect to get paid back here. So what's happening to these bonds? Are they coming up for maturity, and then the owner has to refinance the bond, or how's this all playing out?
Sure. So every AAA bond holder thinks they're going to get paid back.
Exactly.
That's why you buy it. But they a lot of these buildings have not been receiving interest on the bonds for a while. And the minute the appraisals drop and kind of the owners of the buildings get rid of them or sell them, the losses are realized. And the gist of it is that the buildings are worth a fraction of what they were worth a few years ago. So there's just not enough money to pay back everyone, not even the AAA holders. And that's the whole issue. The real estate is just not worth it.
When you're speaking to AAA bondholders, what are they telling you as far as why they might still be holding on to that? What's the risk reward?
A lot of the AAA bond holders will get some money back, the lower tranches won't. And I'm not sure if there's a market for that type of, those type of bonds at the bid they may want them.
And I'm looking at, you have this Big Take story, which means it has great graphics in addition to being well reported, well sourced. Some of these buildings, New York, Chicago, LA, West, 555 West 5th Street, 725 South Figueroa, I know that building. But these things are being valued at significant discounts, right? And some not even covering the amount of the outstanding loan. Yeah. So that's where the problems come in.
Yeah, that's the problem. And it's also a lot of these buildings depend on one single tenant. So the minute that tenant's look, my lease is up, I'm leaving, I want a newer office, this building is really old, the bonds just drop in price because that's where they're getting the income.
I think anytime it comes to anything revolving around real estate, as we know very well, people want to harken back to the global financial crisis in 2008, but this is a very different situation, especially coming out of the pandemic. And talk to us more about how this is a very small subset of the bond market when you're looking at this.
Yes, definitely. Like, there's definitely some type of echo to the, like, similar to the financial crisis in the sense that, like, you don't really see losses on the principal level in AAA bonds. Like, that hasn't happened since 2008. But again, like, it's just a few bonds within the commercial mortgage-backed securities market.
Right. So when you're speaking with your sources, I mean, what are the risks of other broader ripple effects or any sort of other red flags potentially brewing? And then maybe the offside of that where there's more optimism of what could happen.
Yeah, I think like the risk is mainly for any building that's old, like, and that the tenants are walking, there's going to be issues. But if any new building that, like, you know, has a great reputation, has a lot of tenants, like, there's that market is kind of booming. Like, right now in new issue markets, like, buyers are like just gobbling up the debt. Like, so it really depends on the building.
I used to work in one of those buildings in the Garment Center of Manhattan.
Really?
And talk about old. The elevators would break down at least once a week, and the elevator, the shaft, the gears were all made out of wood.
Oh, that's a good sign.
Did you ever get stuck in one?
Oh yeah, all the time. All the time.
How long were you?
Oh, I don't remember. It was years ago. Carmen, we had some beers with us, so
you're fine. Back in the day, Carmen, is there any sense from your reporting that the office real estate market is at or near a bottom, or is anybody calling that, or too early?
Yeah, a lot of people are calling that. Like, when we start to see the office buildings get sold, that's where we've reached the bottom, and then everything is going to go up.
Is there a timeline as far as how long that could take?
Yeah, it can take a long time because, like, the leases are so long that tenants may be locked in for like years. But most people are saying it's between now and the next few months.
Wow, interesting, because there's some iconic buildings here in your thing. I mean, 600 California Street in San Francisco, 1500 Market Street in 15th Street. In Philly. These are some big ones. The Aon Center, which was the former Sears Tower in Chicago. Look at it. I mean, basically half of it's underwater. So crazy, crazy stuff there. We knew it was coming, but somebody's going to have to pay, unfortunately. Carmen Arroyo, credit reporter for Bloomberg News, joining us here on our Bloomberg Interactive Broker Studio. You can read Carmen's story and more stories from Bloomberg at the Bloomberg Terminal and at Bloomberg.com/Big Take. Again, the Big Take stories come out every day from Bloomberg News. They're deep dive stories into really compelling stories, deeply sourced, deeply researched, great graphics, and we just love highlighting them whenever we can. It's a great read.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.